Good afternoon, everyone. Hope everyone is doing well. Today, I'm going to be discussing about business valuation or how to value a common stock. I have discussed in detail, and I'm discussing further in detail under financial analysis lecture series for stock investments and different kind of investments, how to value a business and all. The idea to create a short video lecture under corporate finance lecture series is that the many undergraduate students, they have no idea about the business valuation, so they can get some basic idea about um, how to value a common stock. First and foremost important question is that why should you care? Okay, well, in principle, you don't have to care for anything. Everything is being given to you. But think for a second. If you want to start a business, or if you want to grow the business of your mom and dad and wants to join them, or in some point in time, let's say you're running a business, and some point in time in future you want to take it to the next level and you want to go for IPO, initial public offering, that you allow people to invest in your business. Or let's say you graduate from business school and you are looking for a job, and bank hires you and asks you to value a business or to do stock valuation for X number of companies. So if you don't know basic principles, basic things, how can you do that? So it's always good idea to have some idea about business valuation, whether you decide to go on to that route to be an investor, or you just want to graduate and just be happy. Okay, the people who wants to be into investments or wants to go on to work for Wall Street firms or hedge funds or investment companies or their own investment business, or mutual funds, for example, they need to be very careful with the stock valuation. It's important because it is complex. The complexity comes not because in theory it is difficult. In theory, actually, valuation is very simple, but in practice it is difficult, and there are many reasons why it is so. The basic foremost reason is that you are not running the car, you're not driving, you are not running the business, you are not driving the car. Somebody else is running the business. You are just investing, you are just wants to have a piece of that business in a hope that it would give you the return in future, right? So you got to be very careful. And another thing is that as we all know that it is difficult to trust on in finance area, especially companies. We know that there are accounting loopholes, there are taxation issues, company want to save taxes, um, political issues, uh, economics is the issues related to economy, related to geographical location of the business, market conditions, all those sorts of variable inputs get into these affect the valuation, or these affect the numbers. How would you make sense out of those numbers? So that's the basic idea. And see, imagine a situation that you are seeing a balance sheet and you can't trust the numbers. How would you make judgment out of it? So it becomes very important to look at different aspects. Growth versus income stocks. All the time this question comes. I will leave this question up to you guys. You might decide whether you want to go for a growth company or go for a income stock. It depends. different risk levels for uh, different kind of businesses or different return. Some people are more, risk takers. They might prefer growth stocks. However, you have limited supply of money, or your money is precious, it's a scarce resource. So where would you invest your money? Into company X, which is, say, hope to grow, or company Y, which is stable and giving you regular income in the form of dividends. So it depends. Speculation or investment, that's very interesting thing. I discussed in detail about the speculative nature of the business and your investment analysis under financial analysis lecture series. I would encourage you to watch those videos if you haven't done already. In simple sense, like you go to casino, that's, you decide to, take a trip to Las Vegas, and you are in casino. Now you are tempted to play a game in casino in a hope that you will win something. But see, that's the speculation, that you are gambling onto something, that in a hope that it will give you better return. In the same way, people gamble all the time. People don't know about the business and they buy these stocks, and they suffer later on that, oh, stock went down, I lost money. Okay. And there are people who invest in startup companies, like it's a very risky game, in a hope that this startup company will, um, give you 1,000 times return. Not every company can do that, but yes, there are companies. So there are different ways to look, to analyze qualitatively, quantitatively, those kind of companies, more like people who are angel investors or venture capitalists. It's important for them to look on those aspects. But in this lecture, we have limited time, and so I would try to keep it very short, concise as possible. This is a very, very vast area, business valuation. You can build up expertise in this area if you like to be in this area, but very exciting area to be in. For example, you guys might like a Starbucks coffee, or you might like Tim Hortons coffee, or you might like some other coffee shop, coffee shop's coffee. Say you might go to, say, okay, Morning Shine coffee shop, or your own local coffee shop, and you like the coffee, and you think that, okay, I like the coffee at this place, should I buy this stock or no? Well, wait a second. Now here we go. We need to analyze whether should we buy or not. That's a different question. Okay, coffee might be good, but whether the business is good for your hard-earned money to put in, it's a different question. Let's talk about Starbucks. It's a big coffee giant. Many people know. Many people like Starbucks coffee. Depends. I find coffee is quite expensive at Starbucks, how they sell. That also tells me that their profit margin for coffee might be more. See, coffee, how much is going to cost to them? Few cents, and they are selling it for $5 a coffee. See, the profit margin is huge there. But why? There is a name. They created a good name, Starbucks. Okay, this company is traded on NASDAQ stock exchange and has roughly about 1.48 billion shares, if I'm not wrong, shares outstanding, owned by approximately 6,000 shareholders, which include pension funds, hedge funds, insurance companies, and many other individuals, big or small investors. Now, interesting question comes that, so tomorrow if you decide to say, okay, I want to buy one share of a Starbucks, how much worth it would be? Well, think about a big giant. So even though if you own a tiny fraction of the business, it's worth more. So if you own one share, you would own approximately 0.0000067% of the company. So what you do, how you get the number, you just simply divide by 1 share. How many shares are there total which represent the business? Are 1.48, okay, 1.48 billion. And okay, and you can convert it into percentages. Okay. So what happens is like a big bread, and you are chopping the bread into small pieces so that an individual can buy the pieces. So let's say 100 shares means your whole business is split into 100 pieces. In the same way, Starbucks whole business is split into 1.48 billion shares, and those shares are floating in the market. If somebody is selling, there is an opportunity to buy those shares, and you can go and buy it. Stock exchanges are marketplaces for buying and selling shares. It is very similar to a farmer's marketplace, okay, where farmers, they bring vegetables, they sell vegetables, and you buy vegetables. The farmers who cannot go to farmers market, they send their goods, say vegetables, to their representative agents in the marketplace, right? In the same way, the company's shares are being traded by people, but who is providing the facility? Brokerage companies. They act as an agent for buying and selling. Good, understood? So always remember the analogy of farmers marketplace. Like, I'm not sure how many of you had been to farmers marketplace and really bought some vegetables and did bargain. You might learn from your mom. She might be a very good stock investor. See how they do it, how ladies do it. See, it's a skill in them. To market, they touch the, say you want to buy onions, or your mom want to buy onion. She will look at the onion, she will feel it, she will touch it, then she will say, okay, you are selling the onion at $3 per pound, but I'm not willing to pay $3 per pound. Would you like to sell me to $2.25 per pound? See how they do it. It is in the same way. Same way, when the shares are floating in the marketplace, means onions are there in the marketplace, and you're gonna buy onions. You need onions so that you can make good curry. Okay, in same way. So don't be afraid. Don't be afraid. It's easy, Don't be afraid of a stock exchange. Oh, I'm not good at it. Well, everybody can be good at it. If you are good at buying onions at farmers marketplace, you can be a good investor. Remember that. So let's see an example. Miss Lee, for whatever is the reason, she went to a coffee shop today, and she decided to try Starbucks coffee after a long time. And whatever was the reason, she didn't like the coffee, and she got too angry, and she immediately called her brokerage company that I want to sell some shares of Starbucks. I'm not really happy. Well, so brokerage companies communicates with the stock exchange and finds out the current price of Starbucks is selling at 57.99 and informs to Miss Lee. Miss Lee she's too angry that she immediately wants to sell. So she puts a sell order at the rate of 57.99 equal to market order, or whatever price at the time Starbucks shares are selling. And by putting the order at a market price, it makes sure that she will sell. Okay. Now there is Mr. Wilson. Okay. Mr. Wilson, oh, he's a happy-go-lucky guy. He says, okay, Starbucks, today they didn't give a good coffee. No worries, it happens. The person who is serving the coffee might be in a bad mood, you know. So he decides to buy, and he calls to his brokerage firm that I want to buy some shares of Starbucks. Are there any shares available? Brokerage firm then again communicates with the stock exchange and finds out that the Starbucks shares market price is 57.99 and there is someone sell order is for X number of shares. Good, Mr. Wilson is happy. He puts a buy order, but he's a very smart guy. Probably he has done a good shopping in farmers marketplace. So he thinks that okay, the price might go down a bit. So he puts a buy order of 57.90, less than the market price. Because he's happy-go-lucky guy. He thinks that okay, if I get it's fine. If I don't get it's fine. So he puts his own price. It's a little less. Who knows? If the price goes down, you're gonna buy it. See? So it's very simple. Buying, somebody is a buyer, somebody is a seller. Seller wants to sell, buyer wants to buy. Right? It's the same way like in any economy things work. Same stock exchange is nothing but a marketplace. Okay. Now let's talk about the valuation. Okay. So how people do valuation commonly? Well, they identify some companies, sample companies similar to say Starbucks for example, and examine how much investors in these companies are prepared to pay for each dollar of the asset company own or for each dollar of earning. Okay. They get the numbers for market to book ratio, the price to earning ratio, and they try to compare side by side the similar kind of companies in the same sector. And they come to know, okay, Starbucks is selling 57.99, Tim Hortons is selling 60, or other companies are selling in the same range. And then they try to get a rough idea that okay, if I buy this, my expected return might be in the similar range, But that's a rough way, but not bad, It's like it's very similar to your mom goes to marketplace and there are 10 vendors who are selling the onions. She goes to one vendor, okay, I'm selling at £3, $3 per pound. Another vendor is selling at say $2.90 per pound. Another vendor $2.80 per pound, but quality of the onion is different or different reasons. So the same way, in one sector, many companies are there. They all companies have their own different qualitative, quantitative factors to consider into analysis. Now let's say a very basic thing here. We discussed about discounted cash flow formula in previous lecture. Those who haven't watched previous lecture, I would encourage you to watch it. So what we learned is that say expected return are say if we have given if a dividend for say next year, expected dividend, if we know the expected price, and of course we know the current price, so we can calculate the expected return using this formula, that dividend for the next year plus expected price for next year and then subtract the current price, and then divide everything, whatever is resultant, by the current price. You get the expected return. But now let's say you think that, okay, Starbucks might give me 10% return. So you put a number, your expectation for the return is 10%. So how you going to get the present value, or value at current time? Is that simply your expected dividend and then expected price divided by 1 plus R, that is return. So you get the expected price. Now let's say, good, so now you got the idea about how much price as per your expected return and dividend, how much you are willing to pay now. So let's say if your price, what you calculated, current price P is greater than the stock price. Okay, what it means that you calculated a bigger value than whatever is the market price. It means that the stock is undervalued as per your calculation. Okay, go ahead and buy it. Simple rule, but not in every case, but you need to analyze a bit more. But just a basic indication that it might act as a filtering criteria for different companies, that if your projected value, current value, what you calculated is greater than the current market price, it's undervalued. However, the other way around, if your current value which you calculated is less than the stock price, right, which is stock is traded in the market, it tells you that the price, the stock is overvalued. Okay, so you might wait. It means that the onions are selling at a bit higher rate, so you might wait for a few days and then go again to farmers marketplace and buy onions, right? Same way, very same way. Now let's talk about your time horizon is not 1 year, say 2 years. Same formula you can apply for 2 years. So what gonna be the value? P0 is equal to dividend, expected dividend for next year, plus P2, dividend, expected dividend for the second year, plus P2, that is expected price for the second year, divided by 1 plus R. So what we essentially did, we substituted the P0 formula value for the P1 and so on. So finally we get the equation for, say, for 2 years time frame is that dividend for first year divided by 1 plus R. Here we are assuming the constant rate. Okay, so I was talking about the equation. So dividend first year divided by 1 plus R, plus dividend second year plus price. Your second year, that is your terminal horizon period, divided by 1 plus R square. Now if you want to extend it to, say, n number of years, so we can substitute the values same way, and we can come up with this formula. P0, that is the how much the value of the stock price should be in current time, I equal to 1 to n dividend t divided by 1 plus R to the power t plus price n, means your terminal horizon year, how much is the price, divided by 1 plus rate to the power n. Good, interesting formula here. Now how we can represent it? We can represent it pictorially, that the present value in terms of dollar, let's say $80 per share. That is our current value. We haven't received any dividend yet. So the portion of our present value is equal to, there is no dividend. So it's the whole red bar here. Next year we're going to receive some dividend. So the present value will account for next year's dividend, right, by some fraction. So as the time horizon increases, or the value of the, or the portion of the dividends in our present value equation becomes larger and larger, and the portion of the actual value in our present value becomes lower and lower. Isn't it interesting? It's an interesting fact. We can, draw a curve as well. See the magic of dividends. So your dividends over the period of time, their portion in your present value is increasing. See, that's one of the reasons why investors value high the companies who pay dividends. But let's say the companies, there are many companies, they are valued very high, though they don't pay dividends. But there are reasons why they don't pay dividends. Means they reinvest the money which they can pay you as a dividend, but they decide to reinvest and they grow the assets. It means indirectly they are growing your assets too, because you own the fraction in that big giant company. So if the company grows, your money also grows, your investments also grow. So it depends. You need to look how good they are growing, or how good they are taking care of your the growth thing in terms of investments, if they are not paying dividends. I discussed, it's a vast topic of dividends. I discussed in detail in financial analysis lecture series. If you haven't watched those videos, I would encourage you to watch it. Now, interestingly, another thing here, say, how about your time horizon becomes too long, means let's say infinity. So think about when the time horizon is too large, then your present value calculation just limited to the dividend discounted by a discount factor. Isn't it an interesting fact? So dividend plays a good role, major role here in investments. Always be very careful to analyze how much is the dividend yield, for example, the company has. What is the projected dividend yield gonna be next year? And then, put all those things into your analysis. Okay. Now let's talk about, suppose we forecast a constant growth. But be careful, there is in practice there is no constant growth, but for simplicity let's talk about the constant growth. How we can get the value. Current price is the dividend divided by your dividend rate, and the growth rate minus the growth rate G. Condition is that your R should be greater than G. If R is equal to G, your math doesn't work here. We can also know how much is the rate R from this equation. In other words, we can say that expected return equals the dividend yield. Dividend yield is nothing but your expected dividend, you divide it with the price. So the expected return equals the dividend yield plus expected rate of growth. Okay. Here we assume that the expected rate of growth is constant. However, it is not in real practice. So you have to if you are doing analysis, say for 10 years time horizon, so you need to really get into the each time frame and estimate the growth rate and then continue the analysis. Alternative way is to estimate growth rate is by payout ratio. What is payout ratio? Payout ratio is the ratio of dividends to earnings per share. Okay, so dividend growth rate is equal to 1 minus payout ratio multiplied by ROE, return on equity, right? 1 minus payout ratio we can also call plowback ratio. Okay, very simple formulas. More in detail for examples, calculations. There are some worked examples in your textbook. You can go and solve those examples. Here the idea for the lecture is to give you a conceptual overview about these things. Investors typically separate growth stocks versus income stocks. Growth stocks typically they do not issue dividends, but their growth rate is sharper. Many technology companies fall in that category. Income stocks, on the other hand, they're more stable. They have stable earnings, more or less, a well-defined rate of dividends. So you might expect a consistent income every year from those kind of companies. So it depends, but their return rate might not be that high. So it depends how you balance out your financial portfolio. Always remember, valuing a business is very simple. It's as simple as going to farmers marketplace and buying onions. But in practice, it is much harder. Thank you guys. I hope you have enjoyed this short video on how to value a common stock. If you need private lessons, you may contact me. And thank you for subscribing LEPROFESSEUR YouTube channel. Those who haven't subscribed, I would encourage you to subscribe LEPROFESSEUR YouTube channel. This helps to keep you up to date with the latest videos as soon as I upload them to YouTube. Thank you and have a wonderful day.